Lakshmi Iyer, who is the CEO of Kotak Investment Advisors. Lakshmi, a very good evening and thank you so much for joining us today on ET Now. Looking back, 2022 was a year of rate hikes, We saw yields moving up sharply and not a great phenomena for the bond prices, right? Because bond prices and yields have an inverse relation. But the silver lining here is that in the past 3 months or so, we are seeing some declines and some respite coming in the yield prices. Over all of that, how was 2022 was for you and the debt side of the business? If you can just throw some light on that.
Sure, Srishti. Hi, good evening to you. So firstly, 2022, we have maybe just about a week more to get done with. But by and large, if you go back into the last 12 months, or I would say year to date, I would say it was a mixed kind of an innings across asset classes. I'll drill it down to fixed income. So gold, which was actually, I start off with gold because gold just recently touched an all-time high in rupee terms, which was kind of meddling, it seems like it's ending the year with reasonably early teens in terms of returns. Second, of course, was equities, which had a mixed feeling in terms of some sectors being negative, but by and large, still ended up in high single digits. And fixed income obviously bore the highest brunt, given the fact that we saw a series of interest rate hikes globally and, of course, in India. And the resultant mark to market that we saw is what led to returns being in, I would say, mid single digits. So anywhere between 3.5 to 4.5% has been the last 12 months return. So it's been obviously mixed feelings because you've seen, as you rightly observed, very near term, we've seen some small respite to yields as we are getting a feeler that we are nearing the end of the tightening campaign of interest rates globally. But are we done yet? We don't really think so.
Okay, Lakshmi, but 2022 was indeed a great year for you because you got promoted. So I think that's a thing to cheer about. But coming back to business, looking ahead for 2023, you just mentioned that you don't think that we are still out of the woods. But what could be the likely headwinds? And other than that, what could be the likely tailwinds for the debt side of the business?
Sure. So I think the biggest headwind that still remains is that of inflation. We don't really think that the entire inflation piece, even if we exclude for the volatile food and the fuel items, is totally behind us. Because if you see the latest inflation data in India, while the headline is showing a visible trend line decline, the core inflation still remains to be sticky. So I think that continues to be a reasonable headwind which will continue to plague India in the near term. And even if I take you to the minutes of the meeting, the Monetary Policy Committee minutes that got released yesterday is talking about mixed, I would say, responses, even in the group MPC, which is deciding on the future course of rate action. So it's going to be a choppy movement. And therefore, I would say if I superimpose the global factors, I think that calls for a little bit of guard. But it's fair to say that there is almost light at the end of the tunnel when it comes to rate hikes. So that's as far as the headwinds are concerned. There are some tailwinds very quickly. Globally, we have seen a massive pace of rate hikes in the US, much faster than India. So that seems to be plateauing out. But will it pivot into rate cuts in 2023? That's again not a very slam dunk at the current juncture, but a small, I would say, tailwind is what can support the bond markets going into 2023.
Okay, Lakshmi, going ahead, I want to zoom in on which categories from the debt segment are expected to perform better. But let me just touch upon, before I come to that question, on the interest rates, because you were discussing about that. Where do you see RBI repo rate going forward? Because from the COVID lows of 4% to 6.25% now, that's a jump of 225 basis points. We have already moved up that much. What are your expectations on the policy rate going ahead? Because markets always talk about the Fed's pivot, but where do you see India's terminal rate pivoting?
Answer to that question, Srishti, is a function of where are we likely to see the headline CPI or the inflation which impacts you and me. Where do we see that maybe 3 quarters or 4 quarters hence? So if you look at FY 2024, assuming the current situation remains where it is, and let me take maybe a small padding up of crude oil prices. If inflation for the entire year remains under the 6% range, which looks to be a base case scenario as of now, could we pause maybe at 6.5%, which means another 0.25% jump from the current levels? That seems to be the base case assumption that we are going with. The markets are also pricing in that eventuality. Of course, as I mentioned to you, looking at the minutes, it doesn't seem to be certain, because there seemed to be a dichotomous view emerging in the group whether we should pause in Feb or go for a rate hike. But if I were to stick to one view right now, looks like we could do a 25 basis insurance rate hike in Feb, pause for a bit, look at how inflation pans out, and then take the future course of action with respect to incremental rate hikes if required.
So we'll wait and watch by how that decision comes out to be. But Lakshmi, talking of 2023, you already gave us a broader picture on how the whole segment setup is looking like in terms of the headwinds and the tailwinds. But category-wise, where do you expect the performance or the alpha generation in that? What's your sense in that term?
Again, Srishti, two parts, the way I'd like to take this. One is, if you look at the nature of the yield curve, it's a little bit technical, but it's important for the viewers to understand that from where we started off the year in 2022, the shape of the yield curve was quite steep, which means the shorter end was yielding quite reasonably or significantly lower than the mid to long end in terms of the maturity bucket. As we end the year, the shape of the yield curve has actually flattened out, which means the shorter end of the yield curve has risen much faster, obviously because of the rate hikes that we saw on the benchmark front. So given this kind of a shape of the yield curve, in terms of risk reward profile for the investor, clearly the belly or the middle end of the yield curve, and when I say middle, I'm talking about say 2023, so 3, 4, 5 years, so maybe a 26 to 28, 29 kind of a bucket looks to be a sweet spot for investors on a risk reward basis. The reason being that, as I said, this segment and the longer end of the segment, the ask or the yield that you are getting for taking that additional delta of risk is not very substantial. So it's okay to be in a segment of, create a portfolio in fixed income with a duration of about 3 to 4 years and ride that over the next 12 to 24 months. I think that could be the way forward for fixed income investors.
Thank you so much, Lakshmi. That was quite detailed analysis on, and a very easy way to help our viewers understand on where should they actually looking forward to, and 3 to 5 years is something that you can actually look forward when it comes to the debt investment. But Lakshmi, when it comes to making a portfolio in the debt segment recently and in this year and in the recent past, the retail participation, RBI has been taking steps on that. One such step was RBI Retail Direct. What are your views on that? Maybe in the next 3 to 5 years, how do you see the retail participation? Because still bond is is mostly dominated by the corporate side of the business. But going ahead, how do you see that change happening, particularly out there? And other than that, what steps you feel are to be taken maybe by the corporates or the government to get more people in this? Because we have seen this happening in the stock market, isn't it?
No, very true. So, enough has been spoken about deepening the corporate bond market on the institutional side, retailizing the bond market for the investors. And by the way, it has already started, catching some momentum. Maybe it might not be to the level that we may desire, but certainly we are significantly better than what we were maybe 3 years back in my own experience of tracking these markets. So I would say there are a couple of things which need to be kept in mind. A, you are allowed to participate as a retail investor quite seamlessly among the various vehicles that you have. Mutual fund is a nice and easy way for you to participate into the fixed income journey. In that, there is also another variant where you can buy direct bonds. But the issue over there is a concentration element. And second, most importantly, you need to have absolute understanding of the credit profile. So I would say retail participation is happening largely through more evolved participation on the direct bond side. But please do invoke mutual funds across categories, including a very popular category called the target maturity funds. Please use these as vehicles of participation, because the underlying is something which you should do your homework on, either directly if you know it well, or through your channel partner, advisor, distributor, as the case may be. But not participating because of ignorance, to my mind, Srishti, is very blasphemous, because 2023 holds to be a reasonably good year looking at the current dynamics for fixed income investors.
Okay, and just a last couple of points I wanted to touch with you, Lakshmi, because the next big event that we are looking forward to is the budget, right? Because talking of FY23, the government made a borrowing plan of 14.95 lakh crores. That was the budgeted estimate, and going forward in the second half, they have come up that 5.92 lakhs of crores of borrowing is expected. But FY24, where do you see that number? Maybe this is something that from where the debt market will try to get some cues on that. What are your views on this?
Certainly, the total gross borrowing and, of course, looking at the maturities, the net borrowing will be a number to reckon with for the bond markets. But Srishi, if you ask me, is it going to be a material showstopper? The answer is probably not. We have seen in the second half of this year, for example, there has been a massive uptick in the credit offtake, the credit demand for the banking channel. So therefore, banks as an investment fraternity into government bonds, that number has not really been picking up. In fact, it's actually depleting. But has that really led to a massive jump in the yields? The answer is no. And the reason for that, as I mentioned to you, is investors are also evaluating what is the total portfolio return that you are earning on a given day basis, knowing well the fact that you are nearing the fag end of interest rate hikes. So yes, that number is important. We are not expecting any material surprises, given that one needs to follow the path of fiscal discipline. At the same time, keep mindful view and watch on how the entire global macro is shaping up, and accordingly announce your potential income and expenditure, more importantly, the expenditure part. So yes, keep an eye on it, but I don't think that is going to be the be all and end all. It's also equally important to note for bond markets is in what trajectory the rupee will behave versus the dollar, and of course, how crude oil behavior. I think these are two more important factors over and above the fiscal deficit that the bond markets will concentrate on in the next couple of quarters.
Much, Lakshmi, for telling our viewers what all they need to look forward in FY24. But with this, we'll let you go on that, and would like to thank you for joining us today on ET Now and helping our viewers have the outlook on the next year when it comes to the debt segment.